Hello, I'm Juliette Sarli. In this week's edition of IG Macro Intelligence, we take a look at the February reporting season with a deep dive into two stocks, JB Hi-Fi and Ansell. Retailer JB Hi-Fi posted an 8% rise in first half profit to over $285 million, beating market estimates. The result, a 21% improvement on the first half last year, total sales in the period rising almost 10% to $5.67 billion. Online sales up more than 17.5%, and JB Hi-Fi CEO Terry Smart highlighting strong sales in mobile phones, small appliances and cameras, alongside staple categories like TV and computers as key growth drivers. He went on to say that in a challenging trading environment with increased competition, JB Hi-Fi's priority remains on driving demand by delivering outstanding customer service and exceptional value. Shares in JB Hi-Fi briefly hit a record following the result before retreating as investors shifted their attention to a decline in gross margins. The electronic retailer saw its gross margin decline by 17 basis points to 21.8% in the first half amid increased competition. They declared, though, a fully franked dividend of $1.70, which was up on a year ago but slightly below Citi forecasts. JB Hi-Fi was the first of the major Australian discretionary retailers to report first half earnings ahead of competitors Harvey Norman and Super Retail Group. Analysts expect retailers to benefit from further sales in the second half of the year as the flow-on effect from predicted interest rate cuts boost consumer confidence. And JB Hi-Fi is targeting 5 new stores in full year 25, with 2 already opened in the first half. The retailer also looking to leverage its JB Hi-Fi Perks membership program, which currently has more than 2 million members, and is planning on adopting further AI developments, including AI-enabled device tech upgrades. The retailer may also be looking to lift prices to offset the weakness of the Aussie dollar. CEO Terry Smart saying the fluctuation in the FX market is putting pressure on imports. Analysts called the result encouraging, but noted the subsequent sell-off in JB Hi-Fi's share price meant the market might have been expecting more. Shares have surged more than 60% over the 12 months, with analysts now cautious about further upside for JB Hi-Fi in the current environment. Philip Pepe from Shaw & Partners telling AusBiz the stock keeps defying analyst expectations and could be a $200 stock within the decade.
Look at the 20-year chart or 10-year chart on this company. People have been calling it for a sell for a while based on valuation. Valuation is just one thing that drives performance. If a company continues to outperform probably conservative analyst forecast going forward, this stock will grind higher. So yes, it looks expensive based on analyst price targets today. I think we'll get some upgrades in earnings in the next 24 hours. For me, this is a bottom draw stock. It's always going to look expensive. Quality companies do. It's a buy.
The glove maker Ansell, which reports in US dollars, posted a first half net profit of $55 million US dollars, up from $19.4 million last year. Revenue jumped 30% to just over $1 billion US dollars, boosted in part by its acquisition of Kimberly-Clark assets in July. Sales had been petering off as pandemic-driven demand fades. However, a rebound in first half sales did help Ansell beat estimates and lift its dividend to 22.2 US cents in the first half, up from 16.5 cents. Shares in Ansell rose to their highest level since August 2021 following its earnings update, as the glove maker also lifted its full-year earnings per share estimate. Shares have risen again close to 60% over the past 12 months, with ASX TradeWatch data suggesting the stock can continue rallying in both the short and long term. Brokers are positive on Ansell as it plans to offset potential US tariff hikes with price increases, and the CEO has ruled out shifting jobs to the US. Citi raised its price target on the stock by 17% to $38 following the results. Barrenjoey lifted its target by 15% to $36.20. But UBS has kept a neutral rating with a $36 price target, noting that while the result was better than what the market was looking for, some of that is due to recovery in destocking from the previous period. And UBS is also cautioning management guidance of slower growth in the second half due to headwinds from currency fluctuations. Jefferies, meanwhile, cut its recommendation on the stock to a hold from a buy. And that is your IG Macro Intelligence for this week. We'll see you next week.